Do you want to learn how to make money when a stock goes down in price? How about learning how to protect your existing holdings so even if they crash, you can still sell them at a prearranged price? In this lesson, you will be introduced to one of the most versatile and most widely used financial instruments, put options. We're going to start analyzing put options by looking at a trader who has been looking at the gold market, and he's been analyzing and gauging the interest that people have in gold. And he's come to the conclusion that at $1,600 per troy ounce, the price is going to come down. So he wants to profit from it. The way to do this is he goes to a jeweler and they work out a deal. The jeweler is going to give our trader the right to sell 1 troy ounce of gold at a price of $1,600, which is the current price, during the next 5 days. And for this right, our trader is going to pay our jeweler $50. So now, what the trader figures is that if gold goes down as he's expecting, he'd be able to buy it cheaper. And then since he has this contract, he's going to exercise this contract and he's going to be able to sell the gold that he just bought at the price that was prearranged, which is $1,600. So in this way, he's going to be making money if gold goes down. So now we're going to analyze what happens during these 5 days. On day one, gold stays at $1,600. So basically, he would have no benefit if he exercises this contract. So he won't exercise it, which means that if things stay the same for the duration of the term, he's going to be down $50 because that's the premium that he paid the jeweler. On day two, price starts going down and it goes to $1,550, so $1,550. So at this point, since he paid $50, there could be a benefit for exercising his contract because now the price is below. He could buy it at $1,550 and sell it at $1,600. But he won't because he wants to hold on to it and wait because his contract is going to be active and is going to be valid for 5 days. So there's no incentive for him to do that. At this point, we should mention that since there is a benefit, and if things stay the same for the whole period, there's not going to be any profit, but there won't be any loss either because he's going to be able to sell. If it goes to day number 5 at $1,550, he's going to be able to sell it at $1,600. So he's going to be making $50. And since he paid for this contract the $50, he won't be making any money. So price went down to $1,550. And because of that, he's currently pretty much in an even position. On day 3, price goes down to $1,400. So now he decides that he's going to exercise his contract because now the price went down for a considerable amount. So the trader buys the gold for $1,400, and then he uses his contract. So he exercises his contract so that he can sell it to the jeweler for $1,600, thereby profiting by $200. So this is a cash flow analysis of this transaction. He paid $50 for the contract, then he paid $1,400 for the gold, and then he exercised his contract. So now he got $1,600 because that was one of the terms of the contract. So he's profiting by $150. So right away, one of the things that we can notice is that price went down by $200. So gold went from 1,600 to 1,400. And so it's a all things considered, it could be considered a although it is a decrease, it's not a significant decrease in the price. It's maybe just around 15% or so. But he, our trader, put down $50 to make $150. So the return is 300%, which is quite considerable. On day 4, gold rebounds and bounces back to 1,700. So now it's above the price that's in the contract. So, of course, assuming that he could, because he already exercised it on day 3, but just assuming that he could, he wouldn't, because now why would he sell anything or any troy ounce of gold for 1,600 if he can get it on the open market for 1,700? So the contract basically has no value, and if things stayed the same and he hadn't exercised before, he wouldn't have made any money. On day 5, the last day, gold is trading at 1,900. So same thing. He's going to be down $50, even though the price of gold went up a lot. He still only lost the $50 that he paid in premium for the contract. So there's a couple of things we can notice here. Number one, as you can see, the most that our trader can lose, if we look at all the days, is $50, which is the premium he paid. And another thing is, it doesn't matter how high it goes, he only loses $50. And on the way down, if the price of gold had gone to 1,000, for example, he would have made the $600 difference minus the $50 in premium. So he would have made $550. If the price of gold really crashes and it goes to $200, then he would be making the difference between 1,600 and 200. So he would be making 1,400 minus the $50 that he paid for the premium. So $1,350, $1,350. So you can see that you can make what you paid in premium many times over if you get the direction right, but you can only lose $50. However, if we look at day 1, $1,600, if that had stayed the same for the whole 5 days, then even though the price didn't go down but didn't go up either, he would have been out the premium that he paid. So basically, he needs the price to go down for this contract to have any value. Now, another thing that we can notice here is that in order for the trader to make use of his contract and to take advantage of the decrease in price that happened on day 3, when it dropped down to 1,400, he needed to come up with the money to buy the gold and to actually physically do it. He has to actually acquire it and then use his contract to sell it at the higher price. But this process needs to take place for him to profit. So what will happen if there is a market for, not for the gold, but for the actual contract? So what will happen here is that we create an options market where these contracts are trading, and you can buy and sell pretty much any day, any business day you want in business hours, during business hours. So if you have that, you won't have to actually do the whole process and have to buy the gold and then sell it at the price that was prearranged in the contract. So let's assume that that happens, that there is a market, and we're going to use the same prices that we had for gold in the market. So day one, it's gold is trading at 1600. Then the option is probably going to be worth just about $45 instead of 50. Why is this? Because when the contract was written, when the contract was agreed to, there were 5 days during which the price could change, and the price could potentially go down, making you profit. Now there's only 4 days remaining because we're on day one. So because of this, there is the option is worth a little bit less because the price is the same price. So if we analyze, what will happen is now we don't need to buy any gold. We don't need to do anything. We just take the contract that we had, which we paid $50 for, and we recover $45 out of them. So we would be losing $5. And if we compare it to what happened on the top, so what happened when there was no market, you could see that instead of losing $50, now you're losing $5. On day number 2, starts trading higher. It goes to 1,550. Now it's going to be trading at a price of around $70. Why $70? Well, the contract has an intrinsic value, so it has an inherent value in it, which is the $50 difference between the 1600 that you have the right to sell it at and the current price in the market, which is 1,550. So those $50 at least have to be included in the options, in the contract's price. But on top of that, there is also the possibility, however probable or likely it is, that it could continue to go down, and we have 3 more days to go. So that's priced into the contract as well. Those are the $20 extra that are priced into that contract, thereby giving us a total price of $70. So if we do the analysis, we paid $50 for it. Now we can sell it at 70. We're actually making $20. When there was no market, there was pretty much no way to make money because it's only the 50. If you actually use the contract, you can only profit by the difference between the market price and the option price. Sorry, the market price and the price that the contract allows you to sell it at. So it's only $50. On day 3, now there's a $200 difference between the price, the price in the contract and the real market price. And you incorporate the 2 days remaining. So it's going to be trading at a little bit more than the actual difference, which is $200. So let's say it's trading at $215. Then you're going to have something where you paid $50 and now you can sell it. You can go out to the market and sell it for $215. So you're going to be profiting by 165 instead of the 150 that you were profiting by when there was no market. On day 4, the market price went up to 1,700. And because of that, the contract has no real value. It has no intrinsic value. However, there is still the probability or the possibility, however unlikely it is, that it might go down in the day, in the 1 day that's remaining. So because of this, the contract has actually some residual value. So you can still sell it for, let's say, $10. So it's a contract that you paid for, that you paid $50 for. You can still sell it for $10. So you'd be down $40, but you were down $50 before. So it's still a better situation. On the last day, it's 1900. So because there's no more time remaining, the contract is not going to have any value. So basically you're going to be down the whole amount, the $50. So what we can get from this analysis is that this contract is a good way to profit when you want something to go down, or when you think that something is going to go down. So for example, in this case, our trader thought that gold was going to go down in price, and it did on one of the days on which he exercised the contract, and or actually sold it out on the option market. So it's a good way to profit if something goes down. So this is, if we think about the other type of contract, which is a call option, this is the opposite to it. You want the asset, the underlying asset, to go down for you to profit. The second thing is, it is almost always, there are some particular situations, but for the most part, it's always or almost always better to take your contract that you got and sell it in the market rather than exercising it, buying the asset, and then selling it at the price that was prearranged. So this is the second thing that we need to understand here, that it's always better to go to the options market and do all your transactions there. This market is what allows you to have pretty much 100% liquidity. You can get that contract, and if you need cash for it, even if you're not in a situation, let's say for example our trader weren't able to get the money to actually buy the gold and then sell it out. Instead of that, he doesn't need to get the $1,400 on day 3. He just takes the contract, sells it out, and gets the money. So this is the big, huge advantage of having an options market. And this is how this contract, or this type of contract, which we'll see it's called a put option, can be used to benefit from price going down. Now, what if we wanted to use our contract as a protection, as a protective put? Now we have our trader who's now wearing a gold sweater. So he obviously, he's looking at the price of gold, but now he thinks that the price is going to go higher. So instead of it being $1,600 per troy ounce, now he thinks that it's going to end up somewhere higher. So what he does is, knowing about this contract and how it benefits on the downside, he actually gets the gold, buys the gold, and then arranges the creation of a contract of the same contract that we saw before for the right to sell 1 troy ounce of gold at a price of $1,600 for a duration of 5 days, and for that he's going to pay a premium of $50. So now see the difference here. Instead of having the contract betting that the price is going to go down, now he's going to have the actual gold and a protection by having this contract. So now he's going to have the right to sell at $1,600. But what will happen if it goes higher? If it goes higher, then he's going to profit, and he's not going to have to use his contract at all. So if we do the same analysis, and on day 1 it starts at $1,600, we can see that he's going to be down $50 because he paid $50 for it, and then the price hasn't moved. So that's all the money he's going to be down. On day number 2, when it's at $1,550, you can see that he's going to be down the $50 that he paid for the contract. And now he paid already $1,600 for the gold, and then he can sell it for $1,600. Okay, because now he has a contract that's protecting him. So at all times, he's going to be able to sell it at $1,600. So now he's going to be down $50, the same $50 that he was down at 1,600 when the price was 1,600. On day 3, it goes down to 1,400, and guess what? Same situation. Now he's down the $50 that he paid for in premium, but the gold that he paid for $1,600, he's going to be able to sell at $1,600. So he can always sell at $1,600 because he's got a contract that allows him to do this. So he's down the same $50. On day 4, though, it goes to $1,700. So now he has a contract. So he paid for it about $50, and then he paid $1,600 for the gold, and then now he can sell it for $1,700 because he went in the market. He's not going to use his contract, because why would he use his contract that gives him the right to sell at $1,600 if he can sell at $1,700? So now he's going to be up $50. And on day 5, when it goes to $1,900, now he's going to profit from the increase in the market price, and he's going to have his contract. He's not going to use it, but he had peace of mind through the whole 5 days. Why? Because he knew that at any time he was able to sell at $1,600. So now he's going to be making $250 because it's the difference between $1,600 that he paid for the gold and $1,900 minus what he paid for in premium. Now, in a similar way that we did before, we introduced an options market, which is going to enable us to buy and sell these types of contracts pretty much any business day during business hours. So it's going to be great because now you don't need to come up with you don't need to exercise your contract. You don't need to take your gold and find someone to exercise your contract with. So now you can just take the contract and sell it. So on the first day, the option goes down to $45. So it goes down by $5 because one day passed. So we have if we do the analysis, the $50 that he paid for in premium goes down to $45. So it's a $5 loss there. But the price in the market is the same as the price that he paid for the gold. So there is $5 loss, which is only in the contract. Now, keep in mind, once you sell the contract, you can't exercise it, obviously. So you're going to have to, if you want to close the transaction completely, if you want to be, clear the deck, so to speak, you're going to have to sell it at the market price. On day number 2, it goes to 70. And it goes to 70 because it has, now the price is $15.50. So it's $50 of intrinsic value in the option, and so it goes from 50 to 70, so you make $20 there. But now you have to take the gold that you paid $1,600 for and sell it for $15.50, so you lose $50 there. So altogether you lose $30. Still better than not having an options market, because as we can see on the top portion, you would have lost $50. On day number 3, the option goes to $215 because now it's $1,400. So it's $200 of value that has in the contract plus some value because of how many days are remaining. So $15 extra. So from 50 to 215, but then you have to sell at 1,400. Altogether, if we add them up, it gives you a loss of $35 instead of $50, which is not bad. On day 4, it went to 1,700. So the option itself, the contract itself, is going to be dwindling down to nothing, almost $10 only. But you make money on the actual gold because it went from 1,600 to 1,700. So you take the 50 that you paid, plus you recover 10 out of it, plus you bought for 1,600 and then you sold for 1,700. Altogether, you make $60. Not bad. On day 5, because we ran out of time, the contract goes down to 0, but you made money because Now it's at 1900. So you take the 50, you don't recover anything, but it goes from 1600 to 1900, the actual goal. So you have a profit of $250. So one of the things that's noticeable here is that on day 5, so basically when the contract expires, at that point, when there's no time remaining, there is no benefit, there is no difference between exercising, other than it's a more convoluted process. Other than that, it's the same monetarily. Is the same. $250 is the same profit on both, on the top and on the bottom, on day 5. And another thing is, you just take a look at the profit and losses on every day on both examples, with an option market and without the option market. On the top without, and then on the bottom with. The max loss that we have, no matter what happens, is $50. Why? Because it's the price that we paid for this contract, and that assures us that we won't be selling at any price lower than 1600. So if you look at the line that has the price that we're gonna be selling this for, it's always at least 1600. Why? Because this contract is protecting us. It's putting a floor on the price of the assets that we're protecting. So it's basically, this contract is like an insurance. It's like an insurance policy. So no matter what happens, if you don't use it, great. You're only out the premium that you paid, exactly like an insurance policy. And that's the way insurance works. But if something does happen, so if price goes lower than the price that was prearranged, then you're going to be using it, and you're going to be selling the asset for at least the price that was prearranged. In this case, 1600. So you can see that in any situation, you are always protected. That's why this strategy, that is the combination of a contract, a put option contract, and the asset itself, is called, well, the put is acting as a protective put, and it's also called sometimes a merit put. So basically, another thing that's good about these types of contracts, so the option contracts, is that you can combine them. And we're gonna look at all the different types of strategies that we can have later. But since we can combine them, we can have a certain situation. We can create exactly the situation that we want to create. For example, in this case, the trader wanted to have the pretty much unlimited upside that comes with owning the asset. And if it goes up in price, if it goes higher, he's going to be profiting from it. But also he wants to have protection on the downside. But nothing's free. So for that right, he has to pay the premium. And in this case, the premium in the example is $50. Now, also notice that just like it was the case for calls, it's always the buyer, not the seller. In this case, the jeweler, who was the seller or the option writer, in this case, they don't have a say in when to exercise it. It's only the buyer. That's why this is a right and not an obligation. This is where this differs from something like, for example, a forward contract or a future contract as well. That in the future or forward contract, you're obligated to either buy or sell depending on whether you're short or long the contract. In this case, the buyer decides whether to use it or not, and this decision is not very difficult to figure out. When it's advantageous for him monetarily, he's going to do it, and when it's not, he's not going to do it. But because of this, because he has the right and he has the decision, he pays a premium for it, and the premium always goes from the buyer to the seller. And this is something that's very important to understand, and I hope that is coming through in the explanation. Now let's start identifying where those elements in our examples actually map to real life option contracts. First of all, the contract itself, I'm pretty sure you already figured this one out. It's called a put option, as opposed to a call option that we saw before, or that I hope you had an opportunity to actually check out my previous video. This is a put option. The trader who initiated this is called an option buyer. The jeweler who was the counterpart is called a seller, or an option seller, or a writer. The gold, the 1 troy ounce of gold, is called the underlying. The $1,600 that was the prearranged price is called a strike price. The duration that this contract was valid for on the day that it expires, this is the expiration. This is the how long this is going to be valid for. And the price of the premium, the premium, or the option price or option premium itself is how much the contract itself is worth. And this is what's trading in the options market, and basically the initial transaction as well. Now the actual process of taking the contract and then going to the seller, to the option seller, and making good on it, and in this case selling or putting the asset to the seller, which is why it's called a put option, because you have the right to put that asset to the seller. It's called an exercise for the trader, for the option buyer, and it's an assignment for the option seller. Notice how the option buyer exercises. So it's an active process, and the option seller is assigned. So he or she or they are going to be assigned only they're going to be notified, and they don't have a say in whether it's exercised or not. The right is always with the buyer. This transaction, when it was bought, it's called a buy to open, and when we closed it at the end, it's called a sell to close. Now keep in mind, later on we're going to see certain transactions where you have a sell to open and a buy to close. In this case, you buy the option first. Remember, we're not talking about the assets, we're not talking about the gold, we're talking about the actual contract. So it's a buy to open and a sell to close. And now we have a typical trading platform, an option trading platform, where we have on the top portion, we have the a price chart for an underlying. In this case, the underlying is Facebook, which has ticker symbol of FB, and it's trading just at around $165 thereabouts. So 165, it's what it's trading at. And this is the price chart on the top, and on the bottom we start seeing all the elements that make up the trading page, or the trade page. In this case, we're going to see that when you look at the trading page, usually this is one single broker, which is Thinkorswim, but most brokers, it's laid out in the same or a similar manner. So on the right, you'll see the calls. On the left, you'll see the calls, and on the right, you'll see the puts. These are the put options on the right hand side, and it says puts right there. So all of these are the different puts. Now, we need to know, because there's a lot of numbers there. So which option am I going to be buying or selling or anything? So we're going to be analyzing all this information. So first of all, we have the underlying right here with the white in the white ellipse, and where it says underlying. The underlying price given by a bid and ask, which is the same thing that is being charted in the price chart. The expiration here, we can see that it's May 20th, May of 2020, sorry, and it's got 39 days to go. This is the expiration, but you can see there that there's several expirations, some with 3 days to go, 11 days to go, 18, 25, etc., 46, 74, 165, 228, 284. So these are the different expirations. We expanded the one that we're interested in this case, 39 days to go, but there's plenty of them, and this is the one we picked. Later on, we're going to see that all of these characteristics and all of these terms are predetermined when we want to go to the market and buy or sell an option. So what I mean by that is that we don't get to find a seller and say, okay, I want this option for for next Wednesday. No. There's a predetermined expiration that you have to pick from it. Those are for listed options. You could go what it's called over the counter when you have the opportunity to go to a seller and put together specific terms. But we're talking about here about listed options, the ones that you can go to the option market and easily buy and sell. Those ones are predetermined. For example, we have 3 days to go and 11 days to go and 18 days to go, but we don't have 15 days to go. You have to pick. If you want 15, you can either get 11 or you can get 18. So those are predetermined. Same with the strike prices. As you can see, for example, here, it's predetermined. It's every $5. And it's not always every $5 because it wouldn't make sense for it to be every $5 if the stock is trading at $10. There would only be 2 strike prices. Or if the stock is $2,000. So in this case, there's certain rules, and we're going to look at them later on. But basically here, every $5, there's a strike price. So we can also see that at the $165, which is the price, there is a difference in the prices. So those are the option prices, a bid and an ask. So there is a shaded area with a different color. This is blue, this is black, and this is blue, kind of. So the strike price is very important. Now, we can see that I'm mapping all the different contract terms to a trading page. And that's how you're going to be able to go to the market and buy and sell whatever it is that you want based on any strategy or strategic plan or trading plan that you want to put together that might include options. In this case, you can see that options, in this case puts, are useful when you want the price to go down. So if we do a quick example, so if we have the underlying price at $165 and we want to buy a put that's trading, let's say, $160, it's trading at $627.85. So if we're able to sell or to buy at, let's say, $750, remember something I mentioned in the other lesson, I haven't mentioned here. Every option contract covers, for the most part, 100 shares. So but it's quoted at a price of 1 share. So basically, for the 160 is going to be trading at $7.85. So let's say $8. So those $8 is per share. Because this option is 100 shares, you have to pay $800 to buy 1 contract of the 160 put for May of 2020. So 39 days to go. Now, from 165, let's say the price goes to 150. What will happen? Well, if it expires at 150, this 160 put is going to have a price of $10. So from $8 to $10, you're going to be making those $2.
Now, what if it goes to 140? Well, if it goes down to 140, which would be this area over here, which it has been at 140 before. So if it goes to 140, you'd have a situation where you paid $8, and if it expires at 140, that option, that put, the 160 put, is going to be worth the difference between 160 and 140, which is going to be $20. So it's going to go from 8 to 20, which is 150% profit, which is not bad because we're talking about a drop of maybe from 165 to 140, which should be around maybe 20%, something like that, just around 20%. And you're making 150% profit or return on your investment. So you can see that this is a highly leveraged product, a highly leveraged instrument. And this is one of the many reasons why people are attracted to them. But you need to understand that with this advantage come also many other situations you need to be aware of. Without a doubt, options are very useful instruments, but you need to know how to use them because they're tricky in a way that their pricing is not necessarily linear. And this is something that we're going to be analyzing later on in our website. So now you can see the power of put options. And the same thing would happen if you, as an exercise, you can do, you can analyze what will happen if at 165 you feel that Facebook is going to go up, but you want to make sure that you don't lose a lot if it crashes. So for example, you could be buying the stock in Facebook, so $165. So you buy 100 shares. It's going to have to be 16,500. Or if you have margin, you have to put down half of it. But let's say just 16,500. And then you buy, let's say the 160 strike. And then you pay $8 for it. So $800. So now you're going to have to put down 16,500 and also 800 extra. So it's going to be basically 17,300. And now if Facebook crashes and goes to zero, you can always sell at 160. So you're protected. You have a floor right here at this price. And your upside is unlimited. So if it goes to 200, 300, 400, it doesn't matter because that option that you bought, it's already paid for. You don't need to pay for it anymore. So this is how put options work and how you can take advantage of them, and you can also try to use them in the most efficient way possible. So this concludes our lesson. I hope that it was understandable and that you got a lot of information out of it. I hope that you guys could can hit that subscribe button if you haven't done so, and hopefully you're gonna be sticking around and staying tuned because we're gonna be publishing more information and more videos later on. And I hope this one was useful, and I thank you very much for your attention. Goodbye.